Hey everybody, Marty Mazzora. Happy New Year, 4th of January 2017. Your weekly video. Just going to try to do one a week for you, probably on Wednesdays. I'm going to try to keep it within 5 minutes. If today's a little over, it's going to be because of this intro. I think I'll follow a pattern where I share with you some of the macro data, both on the US and the globe, and then touch on the charts and show you some of the technicals to help keep some perspective on what's going on in the markets, at least technically speaking. Of course, I'll throw in the fundamentals as I go. What you're looking at there is my January trends file. This is where I capture some of what I think are the important statistics going forward. You can see things like consumer confidence per the Conference Board is the highest it's been since 2001. Home prices are rising. China's economy looks okay. There's some debt issues there, but right now I'm not at all worried about China. Bearish activity in treasuries. We're seeing that in a couple of different places. Not a lot of optimism over the treasury market, which means optimism, or I should say maybe pessimism, or a view that interest rates are going up this year. I think that's a logical view. Korea is looking good from an industrial production standpoint. The spike in consumer optimism here in the US bodes well for the market. That's actually a study of that, historically speaking. France's PMI looks good. In fact, Europe pretty much across the board looks good. India's has some short-term issues, self-imposed, based on banning a couple of bigger denominations of bills in India, trying to basically clamp down on corruption by clamping down on cash flowing through the system. That's created some real roadblocks for the Indian economy. I actually like the setup, though. Beyond that, so that may be an opportunity. U.S. manufacturing, fastest growth in 2 years, and so on and so forth. So, folks, when you square all that up without spending a lot of time on it, on balance, in fact, more than on balance, the scale is tipped toward the economy, at least at this juncture, based on the data that's coming in as I speak. Looks good. So it's not hard to understand why there's optimism over financials and industrials and materials, and some of that optimism I've expressed here from our vantage point as well. Okay, so let's jump to the technical setup. And again, each week I'm going to give you maybe a little different look, but right here is your 1-year daily chart that we tend to look at. This is the S&P 500. Here's the February low. There is the Brexit low. And you can see that trend line was pretty much holding up pretty nicely, and then it got broken through as we got close to the election. We got that election bounce, and that looks to be kind of holding right now, and that's a pretty nice looking angle. And clearly we're in a bull market right now, and this is the upward trend. If you draw a trend line to here, you would look for support if we break down below that, somewhere around in that area. To get really kind of into the weeds and look at chart patterns that technicians like to draw, that I'm familiar with, when you come up and you have a nice rally, it's very, very normal to have a consolidation. In fact, a downward sloping kind of a flag pattern before you break out. And clearly we had one here, and then you can see we broke out, and then the Brexit happened, which kind of halted everything there for a bit. We had a hiccup. And then more recently, if you look at, okay, what's going on today, and how does that show up from a pattern standpoint in terms of what we might draw? And it looks to me, at least at this juncture, like we have another kind of a consolidation, downward sloping flag. In fact, let me just pull over for you a definition. Flags and pennants are among the most reliable continuation patterns and only rarely produce a trend reversal. So if that's the right shape, then that would be, at least from a technical perspective, kind of a positive view of the market going forward, and that we had this nice run up here. We have a flag pattern, so it looks like, at least if I were really relying on the technicals, this suggested that the probabilities are such, based on these patterns, that we have more upside to look forward to. Other things we would look at: on balance volume. Here's the volume somewhat drying up, at least the upside volume drying up. That normally would be a negative picture, and I would say that that's telling you that the volume has been coming in to a greater degree on the down days than the up days. So I would put that on the minus column in terms of a negative for the market. This is the advanced decline line. This shows us breadth. This is a very good look. This basically speaks to the number of issues that are going up. In breadth, when you have a good, solid, upward sloping advanced decline line says good things about the market. Moving average convergence divergence, this would have been a sell sign right here. That line is the difference between the 12-day and the 26-day moving averages. Essentially, it just gauges near-term momentum. This shows that it was really slumping. This histogram here tells a little different story. This basically gave us a clue that things are beginning to look back up. So I would say that this is a bearish sign on the near term, but that the prospects look okay going forward. And that move there would support what you'd expect to see in that flag pattern above. Relative strength index, which basically averages the price changes of the market over the previous 14 days, definitely shows falling momentum. That would be a bearish divergence as well. So definitely mixed signals about the market on the near term. I can tell you that during these flag patterns that we're seeing, let me pull this back up, you can see that you should expect a decline in the relative strength index as well as the MACD. Doesn't necessarily suggest things are falling apart, but that flag pattern basically says good things going forward, at least in the near term, about the market. So in closing, folks, I want to show you 2013 once again. I did this the other day in a written commentary. 2013 was the last really good year we had in the market. As you can see, the market was up 30%. One thing that we have to absolutely and forever be cognizant of is that while this looks like a nice straight line, and the 200-day moving average, as I showed you in that commentary, was just a perfectly smooth straight line, just take a look at what being an investor in 2013 and capturing that 30% gain required. Folks, it required living through some pretty gut-wrenching, for people who are sensitive to market volatility, drops or drawdowns in the market, even 7.5%. When you add up all those declines, you ended up with almost 40% of cumulative declines that you had to live through to get a 30% return. I'm not forecasting a 30% return. I'm not forecasting any return whatsoever in 2017. I will tell you the setup looks fine to me. In fact, looks quite good to me. I'll be here to tell you as if and when it changes. But this I can actually tell you to expect, and that would be in any given year. Lots of drawdowns, plenty of places to be concerned about if we get concerned about the short term, which is something I'm going to always preach for you to not do if you can avoid it. Folks, as always, thank you for watching and listening, and look in the next day or two for my weekend letter. Take care. Thanks. Bye.